Not putting a stop loss is one of the most detrimental things you can do as a trader. In this video, I'm going to show you how to put one and why you should really consider always attaching one to your order before you buy. So I'm going to show you guys an example of how you put one. So this is SPY. Obviously, I got the chart all laid out right here for you. Let's say I'm buying. Obviously, this is not, this is after hours, so I'm not actually going to buy. It's just going to be a little demo, not a financial advisor. But I do really recommend you always do trade with a stop. So as you guys can see, when you open up the active trader, you have a stop. Normally it's at the single. I'm going to put it, I have it already set up as just a stop. But if you do a trigger with bracket, TRG with bracket, as you guys can see, if I remove this, I click this, this is where I could always set, I could put stop, and that's how I have it set up that I always have a stop. So that's what I normally always do. So if I'm trading with just a stop, I go and let's say I want to have a 20-cent stop. Let's say this is just whatever, it's probably going to be bigger if you're trading SPY, but this is just illustration purposes. Let's say I'm buying one share wherever, if I'm going to limit out, as you guys can see right next to it, wherever I go, that stop is always attached. So as soon as I buy, there's a stop. So I cannot lose more than, per se, 20 cents in this trade, just how it marks out right here. But that's why I always kind of do have a stop loss attached. Obviously, if you also just put it with the trigger with the bracket, as you guys can see, I could do, let's say I'm doing 2-to-1 risk to reward. Let's say I'm risking 15 cents. It's just obviously is not actually going to work because that's super tight on SPY, but 15 cents to make 30 cents. I'm buying one share, and as you can see, it'll be set out. As soon as I buy, I could literally walk away from the screen because I'll either get stopped out at 15 cents and make 30 cents 2-to-1, which is perfect. Really avoids the stress on your head. You could literally enter in the trade, then just immediately exit the platform. You don't got to worry about managing it because it's automated. I really do like doing that because I feel like it helps you follow your rules so much better. But guys, this is why I always do have a stop attached. The reason I always do have a stop attached is because if you don't, the possibility of things going extremely wrong are extremely high. And let me tell you why. If I don't, let's say I just buy in, I don't have a stop attached. What if as soon as I buy in, obviously emotions start to run higher because money is on the line. What if this, I'm saying I'm going to buy in at 412.40 and my stop is going to be 30 cents below, so I'm at 412.10. Let's say I'm buying a lot of shares, so I'm risking, let's say, $300. So I don't know what the math is. Let's say it's 100 shares per 100 shares. Let's say I think 100 shares times 0.3, right? That would be $30. Let's say I'm risking $30. This thing, if it blows by it and I don't sell exactly once it hits the point that I would be wrong, at least having a stop in will take me out no matter what at that point, or at least near that point if there's some volatility. But you know you're going to get taken out kind of close to that zone. While in comparison, if I just let it go through, let's say I just let it go through. Let's say my stop was, let's say this happened a couple days ago. Let me put this on just so you guys can understand what I'm saying. Let's say I was buying on this day. I want to have a perfect example for you guys. Let's say I'm buying on this day over here. I thought, oh, hey, this level right here is a great level to buy. I want to buy right there. And I get in right here, and I wanted to risk 30 cents. So I'm risking from 82 to 52. So this is where I'm getting stopped out essentially right here. I'll kind of mark it out just so you guys can see everything. I'm getting stopped out right here, right? I'm getting stopped out right here. I'm getting in on this right here. And I thought, oh, hey, market's going to dip and it's going to get a big bounce and I'm going to be able to profit. And if it hits 413.52, I'm getting stopped out. As you guys see, blew through it. If I have my stop in order, I'm getting taken out of the trade immediately. And I don't have to worry about it. I just lost what I risked. Let's say I'm risking $30. I just lost $30. No big deal. Just went to plan. If I would have made money, I would have made money. But let's say I held it. Let's say no, I'm not going to hold it. It's going to bounce. Even though it's below my stop, it's going to bounce. It's going to bounce. And look what happens. Look at the amount of candles that went lower. Let's say you had 100 shares per se, and you're risking 30 cents. You're risking $30. Let's say this ended up going all the way down. How far did this go down? It went down $6. $6 a share you would have lost. You could have risked $30 per se, and you ended up losing 600 because you were stubborn. Emotions fly high when you're in a trade. This happens to everyone. This has actually happened to me before, which is why I always have a stop, because I don't want to be in a trade and be emotional and not take my stop or not take the area I said I was going to sell for a loss at and then hold, and hope. And that never works in trading. It just leads to big losses. So guys, what I recommend, I'm not a financial advisor, is whenever you get in a trade, remember, always put a stop in. I promise it will help you in the future. If you guys like this content, follow me.